Hello, quickly. Today we're going to review the stock Bristol-Myers and Squibb. This is one of the requests by one of the subscriber. Myself, Pramod Kumar. I am a CFA charter holder and FRM certified. So let's get started. So we'll cover quickly the stock valuation, but before we do that, I check on their COVID-19 impact, and as per their 10K annual statement of 2020, they said we have not incurred and not anticipated disruption to the supply of medical. So this means they are not taking any supply on that one. If we quickly look at their business overview, they are the full engaged in discovery, development, license, manufacturing, marketing, and all. Right now, when I'm trying to do the stock valuation, the price in the market is 65.98 cent US dollars, which is pretty close to their daily high range. But if I look into the annual range, it was around 67, so it's pretty close to that as well. Today the company stand at $147.5 billion, but good thing is it's a dividend paying stock, so 2.97 dividend yield. I just want to quickly highlight on the annual statement. So if you can see, the last year company made a net loss of $9 billion, right? And one more thing I would like to highlight, which is very important, that although the company raised enough cash in the previous years from 2016 to this is the latest 2020 to $14 billion from $4 billion that's in their liquid cash. But look at the debt. Debt is $50 billion, which is huge in terms of what they have raised. And I believe they will continue raising this year as well, because they are not supplying any of the COVID vaccine, right? So given in mind, if I see the ratio, it's really alarming. It's 130% compared to their equities, which is, I really don't like it. On the short-term liquidity basis, they don't have any liquidity crunch, so that's good so far. But they're not only the net profit margin, but look at the pre-tax margin as well, which is negative. The gross margin is pretty good, and operating is not that great. It's 11%, but overall they didn't make any profit, which we can see, and it's reflect clearly in their ratios. So let's quickly look into the financial model. So here I'm using the intrinsic value of free cash flow model. So in the free cash flow model, I'm taking the growth of 9%, and then I'm declining the growth year by year, which is pretty normal, to 3% right? And this is on the per free cash flow basis. So I'm taking this growth and projecting the free cash flow, and then using the 10% discount rate, which pretty common I'll use for all the single stocks. So right now the market share is 2.25 billion, and which comes on the per share basis. Basically their total debt on one share is almost $22, which is, you might see, quite alarming, right? And then the total cash what they have on per share basis is $7 only, and free cash flow is 5.91. I noticed this free cash flow not coming mainly from their operation, but from their financing activities, which we seen earlier as well, which is not that great. Overall, that's what their intrinsic value is, coming to 75, almost $76, right? When we see in the market right now is 65. So as compared to this intrinsic value, based on this conservative measures, it looks like the stock is cheap. But given that in 2021 they are not going to make any, I think they will continue making a loss. So if somebody will enter into this price of $65 in a 10-year time, they are looking at 16.15 IRR, right? And this is the whole bandwidth what we are looking. So I make a little bit different kind of video this time, short and to the point. Let me know if you like this kind of a video and what other stocks you want me to cover. So thanks for requesting this video, and hopefully you like it. If you like, subscribe and give a thumbs up, and see you soon in another video. Bye for now.